interest rates, of course, in the past week, for the first time in 18 months, reducing the cash rate by 25 basis points. That's 0.25% to you and I. The move was designed to lower the exchange rate and offset declines in some key commodity prices.
However, many are wondering how the property market will react. Bryce Holdaway is a partner in Empower Wealth and joins us live from Melbourne. Bryce, thank you very much for your time. Firstly, can you give us an indication of how property is performing across the country?
Yeah, Sydney and Melbourne did really well for the last 12 months. Sydney in particular doing about 13% and Melbourne doing 8.5%. But that was a bit of a concern for the Reserve Bank with the fact that it was doing so well compared to some of the other states. But for most property commentators this week, the rate cut did come as a surprise. But I guess the fact that since the beginning of the year, it's the 13th central bank around the world that's actually done that. If we see it from a global perspective, it's not so much of a surprise. But in the microscope view of property in Australia, it is a bit of a surprise.
Bryce, we've heard from economists that we're likely to see interest rates go down maybe another quarter in a month from now. The combined effect of 0.5%, is that likely to further prime the housing market?
Look, I think it's a concern. I've gone on record at the beginning of the year saying that probably Sydney and Melbourne will grow this year, but not as much as the last 12 months. And I think this will probably give it a bit of an extra kick in the tail. But one of the things that they are very concerned about is the overheating of the market. So they put some tools in place, but I guess the biggest one is there's a bit of a glass ceiling in terms of borrowing at a lower rate. So whilst it's good news for people that have mortgages now, anyone who's looking to get into the mortgage market has a buffer in terms of long-term averages. So they're assessing the rates at a much higher rate than you can actually get the interest rates right now. And I think that's a good thing. And I think it's learning some of the lessons from the past with the American model through the GFC.
With really low interest rates and economic volatility, is it a good time to be investing in property?
Look, I think it's it gives a lot of confidence to people. It's a great Australian barbecue topic, Australian residential real estate. So I think one of the things that is going for, residential real estate in the country is, given that Melbourne and Sydney have done so well over the last 12 months, what they're actually suffering now is a bit of a yield issue. And I think some of the underperforming markets throughout the country, with maybe Brisbane in particular and some of the regionals, they may get a bit of a shot in the arm from this, because if investors are still being encouraged to get into the market and being enticed and got a lot of confidence from these low interest rates, they might be looking more for a yield play, given that the growth play has been done in Melbourne and Sydney. So I think that will have a positive impact on some of the other areas around the country that haven't done as well as the two major capitals.
Bryce, what is your view on the perennial question of the way that the market is being distorted by the twin effects of foreign investment in new apartments and also negative gearing for property investors domestically?
Look, I think they're legitimate concerns, and given the fact that last year about almost 60% of loan approvals were given to property investors, which really is underpinning the market. I think it's a challenge, but I guess the argument is always, if you take it away, who's going to provide that housing? And it becomes a huge burden to the government to do that. So I guess the incentives that they give through negative gearing are largely cheaper than the cost of providing it themselves. So I think it is a bit of a challenge. You see some jawboning from the RBA over the last 6 months. They've been talking about it quite strongly, that there is a bit of concern about the bubble. But I think the interest rate cut was largely around getting our currency down, because oil prices are down, and that's also affecting commodity, therefore flowing on to net exports. So as a GDP for the country, the growth is a bit of a concern. So as I said before, in isolation, looking in the property market, you'd think it was a bit of a surprise that interest rates have gone down. But the fact that we are a global player looking to shore up our domestic economy and ensure we stimulate growth, it actually isn't a surprise, and it probably gives a lot of fuel to the thought that, another rate cut is coming, and again, probably a surprise in the context of just property alone.
So Bryce, for those people who are about to jump in their cars and head out for a day of house hunting, can you just summarise the things that they really need to keep in mind at the moment?
The biggest thing is to pressure test your budget at a much higher interest rate, because the sun, although it's looking good for a while, you know, we're at 61-year lows and it's actually, there's an outlook that it may even go down further. The banks are actually learning the lessons of the past and making sure that in any bubble situation, it's usually signified by easy access to credit. So that's not the case. Access to credit is actually still having that buffer in place to see if you can afford it at a higher rate. So anyone who's looking to buy, anyone who's going out to an auction today, they should really be pressure testing their budget at a much higher interest rate than what they've got now, to make sure that long term they won't be putting themselves under any pressure for any decision they make now whilst the interest rates are so low.
Okay, Bryce Holdaway from Empower Wealth, good to talk to you.
Thank you.